key indicators for success in revenue management. So the agenda today is the following. First, we'll go over the introduction and try to understand why revenue actually needs to be managed. We'll go over the basic terminology in revenue management, the basic terms. We'll talk about RevPAR and how it compares to adjusted RevPAR. We'll use some examples so you can better understand the difference. We'll talk about competitors and why it's important to know everything about them. We'll speak about dynamic pricing concept, which is the key to revenue management in today's dynamic market, in today's world. And then we will finish with a few words about automation in revenue management. So why revenue needs to be managed? It seems like a rhetorical question, but not everybody realizes the necessity and importance of managing revenues and paying enough attention to these tasks. Today, hospitality market presents a high level of uncertainty. What customer flow to expect and what price expectations will they have? What will competitors implement today, tomorrow, and every day in the future? How will future events affect revenues, for example, changes in gas prices or airfares or a construction next door? Thus, demand is constantly changing and it's dynamic because the market is not standing still. Besides, now customers are equipped with a wide range of tools that help them navigate in the market of hotel rooms and find deals that don't always contribute to the hotel's revenue growth. For example, numerous OTA and aggregator websites allowing customers to compare room rates, discounted peak websites, mobile apps, and so forth. So in order to be able to respond to these challenge and not to get lost in constantly changing market conditions, every single hotel needs to realize the necessity of adequate daily revenue management. Revenue management goes beyond calculations and formulas. It involves analysis, evaluation, and strategy. It's a science, but also it's an art that one develops and perfects through experience. Now, the main goal of revenue management is to sell the right product to the right customer at the right time and for the right price. So the main indexes used in revenue management science, and many of them you're probably familiar with. Occupancy. This is a percentage of all rental units in the hotel that are occupied at any given time. Occupancy is calculated as number of occupied rooms divided by number of total available rooms. It's expressed as a percentage. So, for example, 75% average occupancy for the month of July 2013. ADR is the second important index used in revenue management. Average rental income per occupied room in a given time period. It's calculated as room revenue divided by number of rooms sold and expressed in monetary units. For example, $85 average daily rate per room for the month of July. Sometimes a hotel's productivity is evaluated based on one of these indexes mentioned above, and more often occupancy. But unfortunately, this limited analysis doesn't reflect the complexity of the relationship between these two indexes and the sales volumes they generate together. So revenue management introduced a more accurate index of measurement, RevPAR, which combines the two occupancy, ADR, and ADR in one statistics. RevPAR, revenue per available room, it's calculated as ADR times occupancy, or total guest room revenue divided by the number of total available rooms divided by the number of days in the period. Revenue per available room is often used to measure hotels' productivity and also to compare different properties within a market. RevPAR allows to obtain a more accurate and broad picture of hotels' performance and also compare the results with competitors in your market. It's recommended that the hotel is signed up to receive monthly Smith Travel Research Report if you're not signed up already. Those reports display the property's performance comparing to other hotels in the market, and those reports are really informative in measuring the hotel's production comparing to what the market is doing. So now let's continue with another index, comparing RevPAR versus a new index that most of you are probably not familiar with, adjusted RevPAR. So let's look at RevPAR in action. Let's use an example. For clarity, we'll look at two extreme scenarios. So let's say a hotel has 100 rooms. Scenario 1. All rooms sold at $10 each. And again, we're talking about extreme scenarios. That's just to show the clear, just to make sure they have a clear understanding of how these numbers are calculated. So 100 rooms sold at $10 each. Revenue is $1,000. RevPAR in this case is $10. On scenario 2, we have the same 100 rooms in the hotel, but only 10 rooms are sold at $100 each. Revenue is $1,000 and RevPAR is the same $10. Now the question is, if RevPAR is the same in both cases, then why do we have a feeling that the second scenario is much more profitable for the hotel? So unfortunately, as you see, RevPAR is also not the most perfect index, regardless of the widely spread opinion in the hotel industry. This statistic does not objectively reflect the performance and profitability of your hotel and particular revenue management techniques you implement due to the following. It does not take cost per occupied room into account, so your variable costs, your expenses. And it also does not take into consideration any additional income a hotel may have from other revenue-generating departments, like restaurants, meeting space, banquet rooms, casinos, parking, spa, and whatnot. So there is one more index that is more accurate and objective. It's called adjusted RevPAR. This index, like RevPAR, can be calculated in a few different ways, depending on what measurements you want to use in your calculations. So here are a few formulas that can be used, and if you would like, we can send you these slides later after the presentation so you can have these on hand. But the simplest way to express adjusted RevPAR is in the following way. It's ADR minus cost per occupied room plus additional revenues per room multiplied by your occupancy. So this is how adjusted RevPAR is calculated. If you remember, the formula for regular RevPAR is just ADR times occupancy. So in this formula you can see that we are also including cost per occupied room, this is your variable expenses, and additional revenues per room. So your additional revenues coming from other revenue generating departments. So this formula is more objective, and it reflects your real profitability at the hotel, comparing to RevPAR, which does not. So let's apply this formula to the above-mentioned scenarios. For simplicity of calculations, let's assume that a hotel does not have any additional revenue-generating departments, which probably most average middle-tier hotels don't. And let's say that cost per occupied room is equal to $8 per room. Now, cost per occupied room varies from hotel to hotel. There is no standard formula of calculating it, but you can calculate it, just come up with a number that's going to be not very accurate, but it will help a lot to concentrate on productivity and profitability of the hotel rather than just the revenue growth, which is much more profitable. And once it's calculated approximately, it can be used for as a constant for future calculations. So normally middle-tier hotels have cost per occupied room at around between $10 to $20, depending on the operations of that particular property. So let's see it in action. Scenario 1, we were talking that there was 100 rooms sold at the hotel at $10 each, revenue $1,000, RevPAR is $10. Let's look at adjusted RevPAR. We decided that cost per occupied room is $8, so we subtract $10 minus 8 equals 2. So our adjusted RevPAR is $2 per room. Our profit is $2 times 100 rooms that we sold. Our profit is $200 in this case. So scenario number 2, we sold 10 rooms at $100 each. Revenue is $1,000, RevPAR is $10. Now adjusted RevPAR is $100, which is our ADR, minus $8, which is our cost per occupied room. Adjusted RevPAR is $92, which is $90 more than in the previous example. our profit is $920, which is $720 more than, again, in previous example. So this is why from the beginning it was clear that the second scenario is much more profitable for the hotel. Thus we can see that RevPAR really does not give us any information about the real profitability, while adjusted RevPAR is a clear reflection of the bottom line profits. It can be calculated fairly easily, again, as soon as you measure your average cost per occupied room. CPSOR, which is cost per occupied room, it can be considered as a constant and be used for any future calculations. And then you will also, if you have any additional revenue generating departments, just a moment, let me see if it looks like I'm disconnected. Let's see, 1 second. Okay, looks like we are online. Okay, I'm sorry for technical difficulties. So we'll continue with adjusted RevPAR explanation. So as soon as you calculate your cost per occupied room and your additional revenues per room, your adjusted RevPAR is going to be easy to calculate. So concentration on RevPAR only can lead to great revenue losses, again, regardless of the belief that the hoteliers have. Because, again, RevPAR itself is not the most perfect index to judge, to assess hotels' performance. But if you set adjusted RevPAR maximization as your main goal, this tactic will lead to increase in the bottom line profits and not to often seeming increase of the hotel's productivity through revenue growth, while final profit can be drastically decreasing. So again, RevPAR growth does not always equal to profit growth, but at the same time, adjusted RevPAR growth will always involve growth in your RevPAR index. Thus, adjusted RevPAR is the index that has to be used as a goal for profit maximization because it reflects the profit which a revenue manager is directly responsible for. One other way to understand whether you are not, whether your hotel is not performing well while your RevPAR is growing is to look at your star report if you're signed up for your Smith Travelers report, and to look at your ADR and occupancy indexes. They normally should be approximately similar to each other. They should be in balance. And if you are concentrating properly on increasing your adjusted RevPAR, which means that you're increasing your profit, your ADR and occupancy indexes will be similar. Though in other scenarios, if you see that your occupancy index is much higher than your ADR index, that means that you are concentrating on selling your rooms more than on increasing your ADR. So you are incurring greater losses while your revenue is growing, your bottom line profits may be going down. So again, it's important to look at your star reports every month or weekly, look at your ADR and occupancy indexes, and concentrate on increasing your profits, not just increasing your revenues, to make sure that your occupancy and ADR are very well balanced. So let's move to our competitors. For correct understanding of the hotel's position in the market, it's important to be aware of the rates that your competitors are charging for any given day in the future. But it does not mean that you have to blindly follow their prices, especially if you use any type of automated tool or of demand forecast and data analysis. Your competitors are not always the best kids in class and don't always adequately react to the changes in demand. Still, it doesn't eliminate the need to be aware of their rates in order to have a clear understanding of what is going on in your market and how you are positioned in it. So there are a few ways to obtain ComStat information. There are manual methods of obtaining the rates of your competition, which many of you are probably using. Call around. So this is when the front desk calls a hotel hotel and asks for occupancy and rates. We all know that we've been receiving these calls as well, and we know that we don't always tell the truth. So this is what happens on the other end as well. This information is not reliable at all. You can't trust a front desk agent telling you about what occupancy and rates they have at any given time. So this information really cannot be used to assess your hotel, your market in the area, and to set your prices. So the second method is manually checking for comp set rates on OTA websites or brand websites. This method is a little more reliable, but it's very time-consuming and it also can be inaccurate. There are also automated tools that can be used to check for comp set prices. There is TravelClick providing Rubicon reports. There is RateTiger, RevCaster, RateGain, and other different companies that provide these tools at relatively inexpensive fees, monthly fees. So they're on subscription basis, and I would recommend that you save your time and make your life easier by subscribing to one of these tools. They're really not expensive, and it will save you a lot of time. So let's move on to the dynamic pricing concept. Effective revenue management requires a lot of planning and forecasting, as we've already talked about. In order to be successful, it's necessary to be able to estimate approximate demand level for every day in the future, at least 365 days ahead. However, setting your room rates for next year doesn't necessarily mean that these rates will remain the same until this day comes. One of the biggest advantages of dynamic pricing concept is its ability to adjust to the real demand fluctuations, even if your initial forecast was inaccurate. As we mentioned earlier, today's market presents a lot of uncertainties for hoteliers. Demand is constantly fluctuating. Every day, managers face a difficult problem to be able to quickly and adequately adapt to these changing conditions and not miss the opportunities for growing hotel revenues. Revenue management is based on supply and demand, as you're probably aware. Prices tend to rise when demand exceeds supply. Conversely, prices tend to fall when supply exceeds demand. Proper pricing adjustments, which take existing demand into account and can even influence it, are the key to increased profitability. The hotel industry is now devoted to developing new forecasting techniques that enable it to respond to changes in supply and demand with optimal rates, which is the core of the dynamic pricing concept. So the hotel industry's focus has shifted from high volume bookings to high profit bookings. So again, as we spoke about earlier when we went over the indexes used in revenue management, previously hotels have been concentrating on increasing occupancy, which is not correct, because by increasing occupancy, ignoring the ADR, hotels bear a lot of losses and they increase their expenses. So instead, the hotel should concentrate on increasing profitability through adjusted RevPAR index. In general, room rates should be increased when demand is strong in order to capitalize on ADR, and lowered when demand is weak in order to increase occupancy. So again, these two indexes are intercorrelated, and we have to concentrate on both of them rather than just one. It's also important to understand that managers' pricing decisions have long-term effects. If you quickly sell a significant portion of your inventory at a low price, then of course your occupancy index will increase, but an important opportunity will be missed. That is to make more money on more profitable clients during the last days that are closer to their arrival. And vice versa, holding your price too high without paying attention to the competitors' prices and slow down in the booking pace will lead to a situation when a lot of inventory remains unsold. So again, I would like to stress that it's important to concentrate on both occupancy and ADR and use the dynamic pricing concept, fluctuating your price depending on the demand and supply. Carefully paying attention to the booking pace as well as your comp set prices, and react accordingly on a daily basis. Hotel room is the most perishable product. One day later and it's gone and cannot be resold. And then, again, that is why it's very important to correctly react to demand fluctuations. Follow your booking pace and select the right strategy and act accordingly. So revenue management, as we already mentioned, is all about predictions and decisions. Predictions about how much and what type of business to expect. and the subsequent decisions a manager makes to get the most revenue and profit from the business through dynamic pricing. The slogan, sell to the right customer at the right time for the right price, sounds relatively simple, but is not easy to be achieved. How do we find out when the right time is, what the right price is, and what type of the customer we're talking about? Management decisions, pricing, and others are based on analysis of vast amounts of information about booking pace, booking history, comp set rates, hotels parameters and specifics, and whatnot. Many decisions are made in the condition of uncertainty. Should I accept an appealing offer from a group of 30 people? If so, I will have to agree to a significant discount, but this would bring me revenue today. But would the hotel be able to make more on the future clients if we decline this group booking request? On the other hand, would the additional revenues from the restaurant and banquet hall offset the lower income from this group due to the discount we are offering them? So what should the ultimate price of this sale should be? So although the individual tasks of revenue management can be performed manually, the most efficient way to handle data and generate profit is through revenue management software, RMS. That's why many hoteliers choose to employ specialized computer programs dedicated to revenue management automation. Today, thanks to great achievements in computer technology and computer networks, automated revenue management has become available for low and middle tier hotels, small hotel chains, and independent properties. Along with that, the effectiveness of dynamic pricing has also increased. Computer revenue management programs analyze large amounts of information about booking pace, historic reservation data, comp set pricing, etc. These programs are normally based on sophisticated algorithms of modeling, forecasting, and optimization. Some systems include elements of artificial intelligence and methods of adaptation or customization to the hotel's specific characteristics. The use of such programs leads to increased revenues and eliminating significant errors in pricing decisions. Using an automated revenue management system, RMS, can lead to about 10% revenue increase in general on average, or even higher in many cases. For hotels that spend their time on manual management, an RMS system will allow to optimize labor, lower payroll expenses, and eliminate significant errors in pricing decisions, especially in the conditions of economic instability. Such systems also allow managers to save time on routine analytical tasks and concentrate on more important strategic decisions. All of the above will, along with increased revenues and profits, as well as stabilization of results, makes managers' lives much easier, increases their productivity, and helps grow revenues more significantly. Applying computer programs to revenue management in hotel business is now widely spread in the US and European markets. So this is all we wanted to speak about today. I hope you enjoyed the presentation. Thank you for your attention. And now we have some time for question and answers. I understand that the audience can raise their hand or send a message via chat. If there's any questions from the audience, and I'll be happy to answer them. In the meanwhile, also, if there is any questions in the future that you would like to ask, please feel free to send me an email at this address that you see on your screen, ira.vogue@i-rates.com. I represent the company iRates, and we welcome your comments and feedback about this presentation, as well as your questions regarding revenue management or revenue management services, revenue management software.